Before we begin this podcast, we'd like to remind listeners that Netwealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. Netwealth Investments Limited is the issuer of Netwealth's financial products. For Netwealth's financial services guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's podcast guest is a financial product issuer. Netwealth and the guest have a commercial arrangement that enables investment in products managed by the guest through Netwealth's platform. Under that arrangement, Netwealth may receive fees from the podcast guest. More information about the fees Netwealth receives is provided in our financial services guide, which is available on our website or by contacting us. Welcome to the Netwealth Portfolio Construction Podcast, brought to you by the Netwealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Netwealth Investment Podcast series. My name is Paul O'Connor and I'm the Head of Investment Management and Research. The Investment Management and Research team looks after both the investments we make available to you through our super and non-superannuation investment platforms, but also the managed funds and managed accounts that we issue. So we naturally spend a lot of time interacting with fund managers. I feel fortunate to have this ongoing interaction as it provides really detailed insight into both markets and the securities held in the various managed funds, and also allows us to develop genuine relationship with portfolio managers and their research teams. Today we have Tobias Bucks from Ausbil, whose responsibilities include portfolio construction and strategy, with a specific focus on developed markets including US, European and Japanese equities. Welcome, Tobias. Recent podcasts have focused on the impact of COVID-19 on the global and Australian economy. So given your role, Tobias, includes a focus on small cap stocks, thought today's discussion we'd sort of discuss the impact of the economic downturn on industries and companies. Ausbil have a broad range of equities strategies covering both Australian and global equities that are available through managed funds on the super and IDPS investment platforms, including a global small cap equities fund. Perhaps to assist listeners, Tobias, could you start with a summary of what are small cap stocks and why would investors even consider including a small cap fund in their portfolio?
Yeah, sure. So thanks very much for having me on. Small caps are listed equities that have a market capitalization of between 500 million US dollars and 5 billion US dollars at the top end generally. So they're reasonably big companies. They're well established. They're very well capitalized. And why would investors want to have small caps in their portfolio is about the return. Global small caps typically deliver much higher returns than mid and large cap equities. So over the last 20 years, global small caps have delivered double the return, slightly more than double the return of global large and mid cap equities. And for that double return, you do get a little bit more volatility, but not much more. And that equates to a much higher risk adjusted return. So the Sharpe ratios are far higher. And when we look at all the different risk-adjusted returns of different equity asset classes, global small caps are the most efficient place to be invested at. They're on what we call the efficient frontier. So it doesn't make sense to just be invested in large cap stocks. You should definitely be invested in small caps. And I guess that leads to quite a key question is why do they have far superior returns? And it's to do with that most of the returns from global large caps are driven by what the company's doing, what the board and the management team are doing with employees, with research and development, with new equipment, new facilities, new marketing teams and acquisitions. Much more by that than what the overall economy is doing. And large cap stocks are much more driven by what the overall economy is doing, which makes sense because they're much bigger and more diversified. It's very hard for them to make immediate changes, or the changes that they do make have much less effect on their overall share price.
Yeah, it's interesting your comments there around the increased volatility of small caps, and I guess that has deterred a lot of investors from using small cap funds in their portfolio. But I guess I also think, like yourself, there that given it's more volatile and probably a riskier investment universe, it also lends itself to considering the use of an active management strategy to not only try and unearth the next sort of Apple or next mega cap company of the next decade, but also to manage the risk and the volatility of the sector there. Um, so moving on to the economic impact of COVID-19, it's I guess it's unknown the duration of isolation policies, and they certainly appear set to continue for a number of years. So in a heightened risk environment, do equities currently look too risky for an investor to consider investing in today?
Well, I don't think so, depending on what your outlook is. I mean, if you need to definitely make sure your assets don't go down at all, then equities might be risky. But for most of the people out there, you do want to have some upside to your capital. Um, so looking forward, I guess the first part is, do isolation policies look set to continue for years? I don't think so. I mean, necessity is the mother of invention. COVID is a novel influenza that has definitely taken the world by surprise and caused a lot of heartache and a lot of sadness, and it's still continuing to cause a lot of deaths around the world. But humans will develop ways to get around it. The isolation policies and the shutdown is an immediate response just to obviously cut down the number of deaths. And we need therapeutic treatments and we need vaccines. I think the therapeutic treatments are improving and there's a lot of effort there, but also on the vaccines, we are getting some much more encouraging news more recently. I think at the start of the outbreak, a lot of experts that I heard and listened to through research were saying absolutely not within 18 months, no chance at all. Um, we're getting the news overnight that Moderna, with an mRNA type of approach to vaccine, which is slightly different from the traditional approach we've had, they think that they're making great ground. AstraZeneca was saying that they could have 30 million doses available for the UK by September and will be in late stage human clinical trials by halfway through this year, so June, July. And AstraZeneca think they could have 100 million doses produced in Q4. There's a number of vaccines around the world. There's ones in Germany, there's ones in the UK, Sanofi's got some, and obviously in the US there's a number two. So I think that the isolation policies could come to an end quicker than people currently think. The US is also developing something called Operation Warp Speed. I think that's its name, which basically is starting to get ready to produce vaccines at a very impressive scale as soon as they are comfortable one of the vaccines in development is safe and has good efficacy. So there could be a lot of upside. I think that it's very difficult to handicap what happens, and certainly I think people will want a vaccine before they get comfortable enough to completely open up. But I think it's too negative to assume that these isolation policies are going to happen for a long time. Also, in terms of equities, you made a really good point about active managers. Ausbil's an active shop in equities. We use our judgment to take advantage of improving corporate earnings and with a very strong focus on improving ESG. And so whilst there's overall the economy is seeing a recession and that could continue given the isolation policies, there are a number of businesses out there that is seeing relatively better corporate earnings outlooks than the overall market, and certainly what you'd get in passive investments. But also there's even some businesses that are actually seeing improving corporate earnings outlooks on the back of this. I think in terms of risky, there's just one other point to probably think about. It's not just so much when the isolation policies end, but what happens to other trends that are going on. So digital trends are accelerating in terms of e-commerce, working from home, but also we're seeing a re-emergence of issues between the US and China as they play out the friction about an emerging superpower, and how the rest of the world will side with that. So I think number of issues there.
Yeah, I guess you do make a key point there, Tobias, that as the crisis has gone on and developed over the last couple of months, the sort of comments and feedback on the a vaccine originally started with saying it could be 2, 3, 4 years, and now I see in the news this morning where equity markets jumped strongly overnight on further positive news on the development of a vaccine. So let's hope you're correct that the duration of the isolation policies is quite short-lived. Equity markets, both in Australia and globally, have been extremely volatile over the last few months since the spread of COVID-19. So, how have small cap stocks performed during this period?
So they're a little bit more volatile. So we've seen global large caps have fallen 34% since the since they started falling in very late February, early March. And then they've rallied 29% off their lows. So global large caps are down 15% overall as a group, and global small caps fell 40%. Um, and they've rallied a lot more. So they've rallied 34%. So they're down around 20% overall. So there's a little bit more volatility there than the large cap. But as you can see, they've rallied a lot more from the lows than global large caps. And if we go into an environment where GDP, the outlook for GDP over 2 to 3 years is improving and accelerating, you would expect global small caps to materially outperform global large caps.
It's interesting that small cap stocks have only slightly underperformed large cap in the down market period of February and March, and probably goes back to your earlier point about why investors should consider having a small cap fund in their portfolio. That they slightly underperformed, but they've outperformed on the upside. So it's certainly a key point to consider. Um, since the outbreak of COVID-19, the central bank's monetary response and government's expansionary fiscal policies that have been announced have been nothing short of extraordinary. So, do you believe these sole actions are really supporting current equity market valuations?
Yeah, I think they're definitely supporting current market valuations. Markets are now discounting a recovery of sorts. As we've spoken about before, it's really hard to handicap where we see the economic outlook over the next 6 to 12 months. But certainly, without the fiscal and monetary stimulus that's come through, it would be likely that equity markets would be discounting a depression, not a recovery. The amount of stimulus that's coming through is unprecedented. Um, you're seeing over 40% of GDP in the US coming through as stimulus, which is a huge amount. So we're seeing stocks are discounting a recovery to trend growth in growth in roughly 2 years' time. If but it's important to also note that equities are discounting trend growth at very low discount rates, which is why we see what appear to be quite high PE multiples at this point in time. So we're seeing the S&P earnings yield is actually at its biggest discount to the long bond yield over the last 50 years. So what that means is that bonds give you such a poor return, particularly in a real yield, that the discount rate with which you'd value future corporate earnings from equities, particularly earnings that are expected to grow over the next 10 to 20 years, is very low, and that gives you that generally should lead to much higher earnings yields. Oh, sorry, price to earnings multiples as a function of those earnings yields.
Yes, well, I guess as cash rates and bond rates have come down and down, the investment theory of the risk-free return has plummeted as well. So, meaning that given everything is typically valued off where cash rates are, I can appreciate your point there that equities, to a degree, do not look particularly expensive in the current environment. Given it appears to be some time, although the caveat being some time before we'll see a vaccine for COVID-19, accepting your comments earlier, on a forward-looking basis, can anyone determine a reasonable estimate for corporate earnings and potential stock price appreciation? And I guess, again, it's just all the unknowns going on in the market, the unknown duration to when we will have a vaccine, and I guess not having full look through at the moment on the damage that's currently being done to the economy. How do you even get a handle on corporate earnings growth and what a stock price is? Or are you trying to look forward maybe 2 to 3 years to move through the noise and the impact of COVID-19?
Yeah, I think there's a bit of that. It is incredibly hard to handicap corporate earnings growth. It's incredibly hard to handicap where GDP is going to be in 3 years' time, let alone where a company's earnings are going to be in 3 years' time in reasonably normal times. So 2016 to 2017, it's hard. In the environment we're in, we're seeing about 25 or a third of companies are pulling guidance, which makes it very, very difficult. So yes, it is hard. I think one of the key things which you allude to at the end there is you want to invest in equities for the future, particularly global small caps. You want to be looking for businesses that in 5 to 10 years' time are going to have delivered a lot of earnings growth. So I think one of the key questions is the business still going to be here in 2 to 3 years' time? Do they have the balance sheet and the capital structure to get through this? And we always focus on that in our process, but certainly at the moment it's key. If you can assume it, you do get through it, then you want to be looking at what it is they're doing with their capital over the next sort of 3 to 5 years to deliver growth. And we really focus on businesses that are compounding value creating events together. I think one of the keys for global small caps is you want to find an emerging global titan. That's what we say we look for the whole time, and to try and give that some color. I think one of the best examples in Australia is CSL. So CSL is a business that everyone should have owned for a long time, and it is an emerging global titan. And then, it was an emerging global titan, and now it is a global titan. And there are particular characteristics that CSL displayed in its past and still displays now that make it a very attractive investment. And I think that's what's key to finding an emerging global titan. It's a niche leader, which I think is key. It's a business that's very well managed. It's operationally well managed, and it's got a strong ability to deploy and allocate capital really well. It is expanding, or did expand organically and through acquisitions, and it's expanded geographically and through adjacent verticals. And it's always had a strong and improving focus on ESG. So that's what we look for. And I think if you focus on that, although you might not be able to predict, say, what Q2 earnings are going to be next year with as high a degree of accuracy as you have been able to in stocks over the last 5 years, what you can do is find a business that's compounding value creating events together on its way to being an emerging global titan. And I think that's the aim of the game, and that's what will deliver strong returns. And we've got a number of businesses like that in our portfolio that we think are going to deliver similar return profiles.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
Interesting. Can you maybe give us an example of one or two of those businesses, Tobias?
Yeah, so we always speak about, so I will be quite limited on this one, is called the Trade Desk. It's a leader in programmatic digital advertising. So that's an area that's growing extremely strongly in advertising. It's a business that's had a very strong focus on ESG considerations, and those focuses have enabled it to take market share off Facebook and Google. Now, if we see Google and Facebook's business models come under particular pressure going forward from a walled garden approach and a lack of visibility approach, where they try and turn the lights off on the internet. Find a business that sets itself up with a focus on ESG, can turn the lights on the internet for advertisers. So that's one that's kicking goals and compounding value, creating events together. Another one we know and like that is probably a little bit less known is a stock called Amplifon, which is a world leader in hearing aid centers. So this is a business that's grown globally. It's in Australia and owns hearing aid centers. And it's compounded value creating events together through not only acquisitions, moving into slightly different verticals, but also improving its ability to deliver hearing aids to people at better quality hearing aids at cheaper prices. So that's one. And then another one that's probably a bit more of an oddball is a stock called Generac, which is a world leader in making generators and now wall batteries and inverters. So Generac's expanded geographically on an organic basis, but also through making acquisitions in the developed world and the developing world. It makes all types of generators for both residential and commercial use, both industrials and hospitals, etc. And it spent a lot of money on R&D to make sure it's a leader, and is now gaining a lot of success in wall batteries, and that's a strong emerging trend. So those are three stocks, and just to try and explain them briefly, they're niche leaders. They're really well managed. They under promise and over deliver. They've got a very strong ability to deploy capital and allocate that capital really well, and they're expanding both organically and through acquisitions, and they're expanding geographically and vertically and into adjacent segments. So that's what we think is the clear characteristics of an emerging global titan, and that's how you get towards finding the next CSLs or the next Google, which the trade desk could be.
Yeah, I think you've articulated those three companies very well, and I guess the one theme in my mind as you've been talking there, Tobias, is the significant long-term growth opportunity to grow their earnings by growing the markets where they're selling their products into, and I guess that that really is what we're trying to find when we're investing in small cap stocks. Those companies that are growing significantly faster than the rest of their universe and the market as a whole. So, in terms of the volatility that's occurred in markets over the last few months, are there industries in the global small cap company universe that have benefited, or is this question better framed on a company specific case by case basis?
I think there definitely are industries and sectors that have benefited. But on a company level, different businesses have taken advantage of these or suffered more in sectors than other ones based on the quality of management and the quality of their assets and staff engagement and other ESG focuses. I think it's some of the working from home and stay at home themes have really benefited certain sectors, and we've seen a lot of our businesses really kick on in terms of earnings expectations, and therefore the share prices which are driven by earnings expectations. So grocery stores are a clear one, digital communication, e-commerce plays, and on the back of it cardboard manufacturers, which is not what I didn't realize that immediately when I worked out that one could see e-commerce was going to take a real kick on here. Didn't immediately see that people who produce board were going to get a kick on too, but cardboard's been a big beneficiary. Truckers have benefited. Gambling and live casinos, we don't have investments in those, but that they've done really well. Takeaway delivery plays obviously have done well. And on the flip side, you've seen bricks and mortar retail, particularly apparel, really suffer. Obviously, airlines, hotels and resorts have suffered. Restaurants have suffered. Out-of-home advertising, and then sort of things that aren't immediately apparent again, but high-speed trains, etc., have seen the outlook for building high-speed train lines has fallen a lot with COVID. So there's a lot of themes there that are reasonably apparent, but they do have a big effect on expectations for future company earnings. I think the main point is you spoke about is that the trends that we've seen play out over the last 5 years have just been accelerated. There's been a massive kick on. So people could work from home and use different software to work from home and do virtual meetings, but we didn't do it that much Now with COVID, it's become trusted and acceptable way of doing things. So we maybe didn't buy everything on the internet before. Now we buy a lot more. So those trends have just seen a big kick on. And we've seen that in a number of our businesses. We stay void of airlines and aerospace manufacturing, void of hotels and resorts and out-of-home advertising. And that's benefited the portfolio. And we've seen strong upside from a grocery network we own in Sweden. E-commerce in our businesses that work hard on e-commerce have done well. Pulp manufacturers have done well. Our truckers have done well. So you do get those benefits coming down to the company, but it's also an important point. Different company management teams, particularly in small caps, have different success on capitalizing on those themes.
Yeah, interesting point you make, Tobias, around the trends of the last 5 years we've been observing have really accelerated in some areas, and I guess we touched on this before the podcast this morning, where we've all been forced to adapt and change, and I think that's typically human nature, that humans adapt and change the most when they have to, when we're cornered. So yeah, I can appreciate that anything around online communications, anything around, I guess, parcel deliveries and those types of industries and supermarkets. Obviously, we've all observed the increase in business and how effectively those industries have been beneficiaries of the recent economic volatility. Moving on to, you touched on ESG earlier, so environmental, social and governance really covers the main criteria, I guess, in assessing the sustainability and societal impact of a company, and this just continues to receive more and more attention from both investors and fund managers. So what's occurring with ESG trends in the small cap universe, and are companies really open to adapting and adopting ESG principles in the way they manage their corporate?
Yeah, it is being adopted. I think ESG research creates a lot of opportunities for returns, and a lot of studies are showing what we've always believed, even back in the noughties, and that's that one of the best predictors of future quality of a company is its momentum or improvement in ESG. So that's always made sense to us. Management teams that really care about their employees, the sustainability of their supply chains, the ethical approach to producing, getting a good company culture, they care about those things as much as the profitability of their business. They're clearly in a much better position to deliver a stronger future for all stakeholders, particularly shareholders. So that's always made sense to us, but over time that's been improved. I think one of the key themes that we've seen is that almost all companies in the small caps, just as much as the large caps, have really cottoned on to the importance of having a great ESG story. So they produce all the ESG documentation and material that investors look for. But ticking all the boxes doesn't necessarily mean that the board is really as good and as focused on these things as they say they are. If you produce the material and you tick the boxes, you will get scored well by ESG rating agencies. And if you get scored well, you'll attract more capital flow as more and more people want to invest with ESG high up on the priority list. But ticking those boxes, I don't think really delivers what people should be looking for. I think you need, especially now more than ever, to know how to research ESG issues thoroughly, really be able to look under the hood. You need that really strong research leadership. It's not about subscribing to ESG rating agencies and saying you incorporate it and listening to proxy voting advisors. It's really about taking leadership, and I think you need specialist frameworks to do it. I think one of the great things about coming to work at Ausbil is that we're at the leading edge of ESG research. We've been recognized as such, and we'd certainly want to be at the leading edge going forward. We've got a dedicated research team led by Mons Castle-Sweeney at Ausbil, and a framework that he's developed that really gets to look at under the hood about what it is that the board of management's doing in particular areas and how to analyze that, rather than just going through the material they put out and ticking the boxes that they've got a whistleblowing policy, a strong code of conduct, the board's independent, etc. All the ticking the boxes really goes under and asks a lot more questions in a fundamental sense. and that's been really beneficial for us. And I think going forward, it's going to be more difficult to discern between what companies actually taking a leadership on ESG issues and what companies just ticking the boxes.
It's interesting your comments there, Tobias. As you're talking, I guess back to my earlier comments where I have a lot of engagement with various fund managers, and everyone's talking about ESG now, and probably not dissimilar to the companies that you're meeting with. I find a lot of fund managers, it's sort of just a very blunt negative screen. That just will be a box ticking exercise where I tend to find the in my opinion, the better quality ESG managers out there are genuinely living and breathing it. They're undertaking qualitative assessment of the companies and particularly the senior management, and whether they're genuinely living and breathing ESG as part of the way that corporate exists, or whether it's giving it some type of lip service because it's seen as the latest trend there. So, do you find that companies are open to engagement on ESG issues? And, well, do you engage with companies? So potentially a company that may not score or be viewed particularly highly by Ausbil, will you then try and potentially engage with them on how they can improve their
Yeah, we do. And I think that's a key part of ESG investing, is to focus on the momentum that board and management teams are undertaking to improve their focus on these considerations. So yeah, we talk to them and we actually make suggestions. I think taking a leadership on not just common ESG factors that people look for, but also modern slavery, the effect of climate change in a few years' time. It's not just obviously how much carbon dioxide you produce, but it's how much you get from your supply chain and how much you produce further down the chain as your products and services are sold. So it's important to engage with people and tell people what you think. And to do that, I think you need to take a position where it's like, this is what we believe and this is why we believe it. And we want to work with you to help you to make our suggestions on how you can improve it. So I mean, one area we've recently been focusing on is modern slavery, which is an interesting topic. And I think everyone does care that there is slavery in the world and we need to abolish it once and for all. So there's a lot of different factors, and I think management teams really appreciate you engaging with them, because everyone wants to have a discussion around what's important for people and what's ethical and what improves returns. And I think taking a deeper lead in your research really helps. I mean, one of the main reasons that the trade desk has outperformed Google and Facebook so much, not only in its market share, but its earnings revisions and therefore its share price, is because it's not just their code of conduct or their whistleblowing or the independence of the board. It's much deeper around what it is they want to provide for their customers, what it is about the way they think the industry should be in the future, to do with lack of personal information so you can't identify people, to showing people efficacy. That there's lots of themes that underlie it that are really important, that aren't always apparent on the surface. And as an investor, you get much better returns for your clients and investors by getting that analysis right.
Yeah, well, I guess also I think in my mind that given you would meet so many different companies and you've got your dedicated ESG research team, you can really bring a relative perspective to the discussion with companies who may not be fully aware of, the trends and the way other companies in their sector, competitors, or even other sectors are embracing and incorporating ESG into the way they run their businesses. And I guess I feel that's a little bit similar with the various fund managers that I deal with, in terms of seeing some managers, to my earlier comments there, that have dedicated research and undertake very positive, qualitative type research to make sure that they fully understand from an ESG perspective how a company is being managed there. So I think to a degree you have an important role to play there, Tobias, in continuing to encourage good ESG management among the corporates that you research. So we finish our podcast typically, Tobias, with asking our guests for any personal investing tips that you've applied through life and perhaps is central to your own personal investment philosophy. So do you have one or two tips you could share with our listeners?
Yeah, I think my personal philosophy, came up with this, I guess, myself, but because it's how I understand things. But it is that markets are very efficient, but they have no imagination. And for me, that's absolutely key. Markets are much more efficient than you can ever be as an investor, especially with high frequency trades, momentum algorithms, and all the new technology that's being developed in markets. But the markets can never be as imaginative as you can be as an investor. So having a really strong and balanced imagination is key. And imagination is the way to get alpha out of a market, particularly in global small caps.
Must be becoming a little harder at the moment, given all the momentum investors that seem to follow each other. So having a different view and a different thought, I can understand your point. It could certainly result in strong outperformance. Yeah, so interesting.
Yeah, I think it's key, and like you say, now even more important than ever. And I think that the second one is just the old mantra that I think is so important is you've got to do your own research. You've got to work hard. That the harder you work, the luckier you get. It's just the absolute truth. There's 4,500 companies in my universe, and I'm looking for emerging global titans, and there's not that many of them. But you got to keep looking and keep looking and keep doing your own research. Don't take everything you read as true, and just work hard and keep looking till you find the gems. I think that's the most important other point. The harder you work, the luckier you get.
Yeah, well, I guess ultimately, as my father said to me as a young fella, you make your own luck in life. So I think that's what you're saying there, Tobias. So, Tobias, thank you very much for joining us this morning. It's certainly been an interesting discussion in terms of your and Ausbil's views on global small caps and the current economic volatility that we're currently living through. So thank you for your time this morning. It's been really appreciated.
Thanks a lot.
To our listeners, thank you very much for joining us. I wish you all the best during these current times, extraordinary times that we're living through, and I hope you have a great day. Thank you.
Thanks for listening to this episode of the Net Wealth Portfolio Construction Podcast Series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.